Welcome to the Explainer. So, you've probably noticed the market's looking a bit pricey, right? Today, we're digging into a Barron's article that tackles a super important question. Where do you find a little bit of a safety net in times like these?
Let's kick things off with this line from the article because it's just too good. It says the market is on dividend Ozempic. I mean, what a great analogy, right? It immediately paints this picture of something getting slimmed down, maybe a little too much.
So what exactly is on this diet? Well, it's dividends. The article points out something pretty startling. The percentage of company earnings getting paid out to us, the shareholders, just hit a 25-year low. A 25-year low. I mean, the market has basically put itself on a crash diet, and those dividend payouts are looking seriously lean.
And this number right here, 24, this tells you a huge part of the story. That's the S&P 500's current price-to-earnings ratio. It's one of the main ways we measure if the market is cheap or, expensive. And let me tell you, 24 is way, way higher than the historical average. It's basically the market flashing a big sign that says, yep, I'm pricey.
And we're not just talking a little bit pricey. The article brings in some research from Deutsche Bank that says we're in some pretty rare territory here. In fact, valuations have only been this sky high 3 other times in the past century. And get this, every single one of those times was followed by a pretty rough decade for investors with negative returns after you account for inflation. Yikes. Okay, so that naturally brings up a huge question, right? If the main market is stretched so thin, where on earth are you supposed to look for returns? And maybe even more important, where do you find a little stability? Well, the article suggests we should turn our attention back to those things that have kind of been forgotten. Dividends. And if you need convincing, just look at this number, 55%. That's the historical case for dividends right there. Between 1987 and the middle of 2024, if you had just reinvested your dividends, they would have accounted for a massive 55% of the stock market's total returns. It's a huge reminder that while they might not be the most exciting thing, these steady payments have been an absolute powerhouse for long-term growth. You know, the author makes a really smart comparison here. He calls dividend stocks cheap and unloved right now, and that probably sounds familiar, right? Because that's exactly what people were saying about overseas stocks at the start of the year. And then, bam, look what happened. While the US market had a great run at 16%, overseas markets literally doubled that. It just goes to show you, sometimes the thing that's out of favor is the very thing that's about to have its moment in the sun.
All right, so let's say you're on board. You're thinking, okay, adding some dividends sounds like a smart move, but where do you even start? Well, the article breaks it down into 2 main paths. You can go broad with funds, or you can get your hands dirty and pick individual stocks.
So let's talk about the ETF approach first. This is kind of like the one-stop shop for dividend investing. Instead of having to research dozens and dozens of different companies, you can just buy one single fund that holds a whole diversified basket of them for you. Simple, right? But here's the thing, not all dividend ETFs are created equal. The article zooms in on 3 from iShares, and each one has its own, flavor. You've got HDIV, which is a solid, balanced approach that just tracks a big index. Then there's HDV, which is for you if you're thinking, I want more income right now, even if the growth is a little slower. And then on the flip side, you've got DGRO. This one's all about companies with zippy dividend growth, but you're going to start with a lower yield. So it really comes down to what you're looking for. Cash in your pocket now, or potentially more growth down the road.
But okay, what if you're not an ETF person? What if you like a more hands-on approach? Well, for that, the article brings in an expert, a stock picker named Matt Quinlan from Franklin Templeton, to give us some specific company ideas that fit these different dividend profiles.
First up, for all you growth investors out there, Quinlan points to companies like Apollo, Marriott, and Parker Hannifin. Now, you might look at their starting yields, 1%, 1.5%, and think, that's not much. But that's not the point here. The real magic is the potential for those dividend payments to grow at a super fast, low double-digit pace year after year.
But what if you need more income today? For that, Quinlan suggests a totally different group of stocks. Think companies like Cisco, RTX, and Philip Morris International. These guys offer a much more generous starting yield right off the bat, combined with more moderate but still really steady growth. It's that classic trade-off, right? More income now versus potentially faster growth later.
Okay, so we've looked at the pricey market, we've explored different ways to bring dividends into the picture. So what's the big takeaway here? What's the bottom line we should all be thinking about? Let's just put it all together. Point one, the market is expensive, like historically expensive. In that kind of environment, dividend stocks, which are kind of cheap and unloved right now, start to look really interesting. Why? Because they can provide that potential cushion, right? A source of return and maybe a little peace of mind if the broader market decides to take a nosedive. And the great thing is, you've got options. Whether you like the simple all-in-one approach of an ETF or you want to get specific with individual stocks, there are clear ways to add that cushion.
And that brings us to our final thought. This question really gets to the core of the whole article. In this constant search for returns, how much is a cushion actually worth to you? You know, when markets are just going up and up, it's so easy to forget about risk. But building that cushion, it isn't just about preparing for a bad day. It's about deciding what price you're willing to pay for a much smoother ride.